The Indian stock markets has been on a roller coaster ride over past 5 months, with benchmark indices like Sensex and Nifty50 witnessing a huge downturn. Nifty50 was trading at around 26,300 levels, which is at all-time high, but from there it reached almost 22,800 points level. If we observe, it's a significant decline of around 3,000 plus points. But why are markets falling so much? What are the reasons? In this video, we'll discuss all the parameters which has contributed to the decline of the markets. So let's start with the first reason, which is the weak corporate earnings. In Q3 FY25, several major companies have reported weaker than expected results, and even many companies experienced declining profits. But what's the reason of declining profits? Three major reasons: rising input costs, inflationary pressures, and weak consumption. All these factors increase the burden on the companies, which in turn led to the declining in the profits. Not just one segment or one sector, almost all category of stocks have impacted because of these reasons. So when a company reports weak financials, it will negatively impact the stock price of the company. And what if majority of the stocks report weak financials? It will create an overall negative scenario of the market. And that's what happened. So when companies report decline in the profits, the EPS of the company will also get reduced. And when a company is having higher PE, which means the valuation of the company is higher. And this is where we should discuss about the second point, valuations. Aswath Damodaran, who is considered as the valuation guru, has mentioned some points in his blog. In his latest blog, Damodaran, who is an expert on stock valuation, said the most expensive market in the world is India, and no amount of hand-waving about the India story can justify paying 31 times earnings, 3 times revenue, and 20 times EBITDA. So this means we are paying 31 times the earnings of the companies and 3 times more than the revenue and almost 20 times the EBITDA. So it clearly indicates how overvalued the Indian markets are. So as the companies announced weaker earnings and also the valuations are also so high, so in order to justify those valuations, the companies needs to increase their profits. And these scenarios have created panic in the market, and that led to a significant fall. But not just that, there are two more major reasons. The third reason is FIIs selling. FIIs, also known as foreign institutional investors, have been on a relentless selling spree. Since September 2024, the overall outflow of FII is around 3 lakh crores, and the trend continued in 2025 with over 1 lakh crore already withdrawn. January witnessed a staggering 87,000 crores sell-off, followed by 29,000 crores in February so far. And if you look at the data here, in February they sold nearly 29,000 crores, and in January 87,000 crores, December 16,000 crores, November 45,000 crores, and in October 1,14,000 crores. So overall it is around 3 lakh crores. But there is one more strong reason for the FII selling, and that's where we need to discuss our fourth point, which is Trump factor. After winning US elections in November, Trump took charge and started taking big decisions. He started imposing heavy tariffs on Canada, Mexico, and China, so which led to the global uncertainty. Interestingly, he introduced reciprocal tariffs, which means if another country taxed US goods, he would tax their goods in return. And later, he imposed a 25% tariffs on pharmaceuticals, metals, and he also imposed tariffs on fertilizers. So these higher costs may hurt many industries, making businesses and investors nervous. As a result, market sentiment turned negative, leading to a decline in stock prices. So when US imposed tariffs on particular product, the businesses which are manufacturing or producing that particular product will get hurt. And especially when he is imposing tariffs on imports, it will impact the business of foreign countries. So the US will be a better place for FIIs when US is imposing tariffs on foreign countries. So it might be another reason why FIIs are selling so much. Now that we know why the markets are falling. But the big question is what to do next. Should you sell in panic, hold, or buy more? So this is where expert guidance matters. A SEBI-registered investment advisor like Savart can help you navigate these volatile situations. Instead of reacting emotionally, professional portfolio management focuses on long-term strategies, diversification, stock selection, and based on fundamentals. And during these market fall conditions, Savart has generated about 4% alpha compared to the benchmarks. Market volatility isn't new, and those who stay invested smartly tend to benefit in the long run. But making the right decisions require patience, knowledge, and expert advice. So if you need any help in navigating these volatile markets, Savart is always there for you to help you. So like, share, and subscribe for more market insights.